phase two correction. Oh, and then phase three correction to the top. Oh, maybe it is. Maybe it could be. That's what we're talking about. So all the people are like, when banana, it's the same fucking banana. It's just, it's going to be a bigger banana. And I know you like big bananas. Really? So the banana's bigger than you can handle.
In this powerful and unifying theory of macro investor Raoul Pal, he is arguing that the complexity of financial markets can be distilled down to a single macro variable. This one factor, he contends, is global liquidity, and it explains over 90% of the price action in both the Nasdaq and crypto. Everything else, every headline, every narrative, every fear, is simply noise and wiggles around this dominant trend. This framework, he asserts, provides the easiest macro risk-taking opportunity of all time. If you can understand the direction of global liquidity, you can understand the direction of all major risk assets, allowing you to tune out the distractions and focus on the one thing that truly matters.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Here's total global liquidity. We're pretty much at all-time highs as liquidity is growing at 8% a year. That is the liquidity we think of because we're crypto people or technology investors. We think of this as great. For everybody else, including for your income, this is debasement of currency and it's totally screwing you over. Your cash savings, all of that, it's all based around this. If you're not beating this 8% annualized growth rate of global liquidity plus 3% inflation, that's 11%, your future self is getting poorer. This is the game we're in. This is why we're taking absurd, ridiculous, irresponsibly long risks in technology and crypto is to unfuck our futures. It is what Bitcoin is. It is what Nasdaq is. It is what is driving markets. In addition, there are two different scales here. Why? Because Bitcoin is exponential based on Metcalfe's law, which is a network adoption model. So over time, you get the outperformance of the network plus the debasement, which is why it's la land in terms of performance. Bitcoin, Ethereum, all the big tokens. I use Bitcoin because it's easiest, it's got the longest track record to show people within. But Solana, Sui, you choose your thing. It's all based around the same thing. Why it matters, it has a 90% correlation. So 90% of the price action of Bitcoin is explained by this one macro factor, liquidity. Oh, and by the way, 96% of the Nasdaq. So what we have, and I keep trying to explain this to people, I'll explain to them tomorrow in more depth. We have a single macro variable that explains 90% of the price action of every major asset. That makes it the easiest macro risk-taking opportunity of all time because everything else is noise. Everything is just wiggles. You see the wiggles. These are wiggles. It's just noise. Wiggles. It's all noise because this is the trend. You just need to understand liquidity and then you understand the directionality. Global liquidity, what's it doing? Well, global liquidity year on year is not at all-time highs. So we're not at the acceleration phase. We've seen global liquidity increasing. It's just ticking down recently. Oh, guess what? The markets have ticked down a bit. Bizarrely, this was the banana zone phase one correction, start of phase two. We think it starts doing more of this now, which is the acceleration phase. It won't do this because obviously we don't have a pandemic. So we're looking for liquidity to rise to something like 10 to 15% a year, stay there for a while, and that will start really driving assets. Here's the 12-week lead. Since July 16th, 2025, we've seen this weird underperformance. And I was like, it's broken. It's broken. See, you are morons for following this. People start forgetting about it. We don't forget. You see, what has happened in the meantime is the Treasury General Account, that is the Fed, the Treasury, have been issuing bonds to top up their general account, which is taking cash out of the system. So they've withdrawn about 500 billion since July the 16th. That has hit risk assets somewhat. And of all the risk assets, the one that's most susceptible to liquidity is crypto. So crypto got that, which has been this choppy, it went up, alts have been outperforming. Then they came back down again, and it's been just a bit sloppy. Nothing more than that. There's been nothing really adverse going on, just a bit sloppy. Top of the range for ETH, top of the range for Sol, tried to break out, came back down. Fine. But generally it's because they're sloppy because liquidity has been taken out very fast. The liquidity withdrawal stops about here. We're at the point where we don't need to withdraw any more liquidity and the Treasury General Account is topped up. Okay, so that negative thing has gone probably today, tomorrow, this week, next week, whatever. It's gone. And we start to see that liquidity will play catch up. Does it catch up to this chart? I don't know, but it always has done in the past. And I'll come on to the past in a sec. Okay, then we go to the Nasdaq. It's actually done really well in recent times, following this beautifully, because 97% of Nasdaq's performance is explained by this. But look at this in the past. Nasdaq can do this shit too. This is all based on flows. So Nasdaq is getting consistent flows based on this technology bid that's going on. And it's sucking in capital from foreign investors, etc. And Bitcoin just has been sloppy because it's had less of the capital that was available. So it's the marginal capital. As the marginal capital comes back, Bitcoin outperforms. And I'll show you that. So here is, in fact, here is the chart of Bitcoin versus Nasdaq since 2022. So Bitcoin's been outperforming Nasdaq. That's its job. That's what it does. This is why we own it. And it does these kind of nice corrective patterns up, corrective pattern up. And what we've done is we're back near this old 2 standard deviation favorite place of ours, where generally Bitcoin outperforms. Now, I've noticed many of you, and I noticed on X, are all like punting tech stocks and saying, well, crypto, it's boring. It's changed. The market's changed. They're all different now. It's not. Just shit happens. Short periods of time. So that happens. And what will happen is the more of you, I even heard from good hedge fund in crypto, they're like, yeah, we're thinking we're just going to trade more stocks now because, you know, the crypto market's not the same. So what they're suffering from is this.
The core of Pal's current analysis explains why crypto has recently underperformed and felt sloppy. The culprit he identifies is a temporary $500 billion liquidity drain caused by the U.S. Treasury refilling its general account. As the asset class most sensitive to marginal liquidity, crypto felt this drain most acutely. However, Pal declares that this headwind is now over. Compounding this, he presents a groundbreaking discovery. The traditional 4-year business cycle has been extended to 5 years, a direct result of the Treasury extending its debt maturity profile in 2021. This means the current bull market is destined to run longer and push prices higher than historical models would suggest, likely peaking in mid-2026.
But basically, it's following the ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the everything code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. They get rates lower. Why? Why do we have an elongated business cycle that looks like virtually no other other time? It's because, and I only just found this out redoing the work on the everything code recently, is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced. Whether it comes back to 4 because they managed to get some stuff at the long end, or whether they shorten it because everything's in the short end. We don't know yet. But this one is a 5-year cycle. And this is what it looks like. The 5.4-year sine curve, 5.4 years is the exact average weighted maturity of the debt. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that, as the rate of change of ISM changes and the rate of change of liquidity changes. Our best guess remains well into 2026, probably Q2. We'll have more information on that in due course. Part of that is driven by our financial conditions index. This leads the ISM by 9 months. It says in 9 months' time, we're in September, so this is June, the RSM will be 56.3. That's still not racy at the tops of the cycle. It actually gets usually a bit higher than that. It usually gets to sort of 58, maybe 60. Regardless of where we get to, in 9 months' time, the ISM will be that. That's June of next year. That tells you the cycle, probabilistically speaking, will end up going up until Q2 next year. So remember that M2 chart? I see a lot of bullshit, again, as ever, on X saying, well, it doesn't work. It's never really worked in the past, blah, 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 blah. So here is what it did with the 12-week lead applied in what we think is the most similar cycle to this one, which is the 17 cycle, 16, 17 cycle. And back then, Bitcoin followed it really well. It worked really well. And in fact, Bitcoin peaked after Global M2 peaked. But you can see how well these things work. They're not perfect. Look at all of these divergences where you're losing your shit saying, well, it's doing different things. It's underperformed here. Bitcoin outperforms here. It's underperformed here. Why is it underperforming? In the end, it's all bloody noise. So that's what we're saying. The other one is when we look at a similarity of that pattern, we kind of see that 2026 is more 2017. And that somewhere contextually there's this extra year and it feels like it's all to play for. And it's very remarkably similar pattern. Again, we're not looking for this to repeat perfectly. We're giving contextualization that if we go longer, the price is going to go higher than people expect. That's a function of that log regression channel I often show you. And I think that is the most likely outcome.
Ultimately, Pal's framework provides a clear roadmap for the next phase of this bull market, which he calls the banana zone. By comparing the current global liquidity cycle to the most similar historical precedent, the 2016-2017 cycle, he demonstrates that periods of divergence are normal and temporary. The underlying trend is all that matters. As the temporary liquidity drain ends and the extended 5-year cycle plays out, he expects a powerful acceleration phase to begin. His message to investors growing weary of the recent chop is simple. What feels like a fundamental market shift is just short-term noise. The single most important variable in all of finance is pointing unequivocally higher.